Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, look to see what the news is being released, look at some data, information pertaining to the commodity markets, pertaining to the financial markets. And then what I do is I bounce all that data, information off of technical analysis on the charts, seeing what the markets and what the herd is trading in the markets and what it looks like technically. What we look for are those two to converge together. We call it confluence of information, the merging of information, of technicals, fundamentals, and having that all come into alignment where everything looks good for one direction or the other. Right now, we've got news, data, fundamentals, technicals, it's all over the place. So generally, when things come into alignment, you're at bottoms or you're at tops. And when you're in transition periods between these tops and bottoms, the data becomes messy because some signals are still good from the previous move, and some signals are starting to change for the next move. And I think that's similar to where we're at. But again, you can also have false signals for certain sectors. And sometimes they do a false breakout and then go in the opposite direction from a technical standpoint. And that's why you want to marry up as much information as possible. You want to marry up the fundamentals. You want to marry up the technicals. You want to take into consideration even tertiary signals, which is around those markets. So if you're an oil guy, you want to see what the overall markets are doing over here. You want to see what bonds are doing over there. They all interlock together to create one big picture. So let's dive in for the Twitter updates and news. And again, if you want to follow me, it's at finding_finance. And if you want to join the website and join our community, you can join finding-value.com and use the word discount for in the coupon code for a discount. So Mike Simonson, and I like talking about all sorts of data. It all matters, guys. So when he says, bottom line, the housing market rebound this spring is stronger than you think. Supply is severely restricted, only 66,000 new single-family listings. Demand exceeds supply. Demand exceeds supply. Home prices have stopped the declines of the second half of 2022. So this is the only 66K here. New listings this week, 25% are already in contract. So things are heating up, even though demand has fallen, supply has fallen quite a bit. So supply is falling faster than potentially demand. So coming in here, we've got active inventory of available single-family units or single-family homes for sale, dropped again to 405,000 this week. As someone else pointed out last week, inventory could be back at record lows in Q3 if this trend continues. I don't think we'll hit that, but still. So this is your inventory. It falls down to 405. So we've been sucking through our inventory, and we're at very low levels for active inventory. Just wanted to let you guys know that. It says, that being said, prices are not jumping, but they are ticking up. Comparisons to 2022 will keep getting worse until Q3. Median price of single-family homes is $440, still up a tad over 2022. Median price of the new listings is $399, about 4% lower than last year. There is your median asking price, still fractionally up over last year. Last year is this guy. This is median price of new listings. This is median price here, and then over last year, it's just a fractionally above over last year. Looking at it, says the median price of the pendings, the homes that will sell in April, May, June, is $379. That's up a tick from last week and 2% lower than 2022. The sales price headlines will report negative HPA until August at least, even as prices are actually inching up. So we could see a little bit lower than last year. You can see last year's 2022 median price of homes, and this is 2023, and it is slightly lower by 1.6%. That is not really a crash, is it? I don't know. It says we can see this surprising rebound in the price reductions data too. 29.8% of homes on the market have taken a price cut. Remember that headlines we hear now reflect the ice cold demand of 40% plus price cuts of the Q4 market. Let's look forward, not backwards. Demand exceeds supply, prices are reacting accordingly, and even though the price comparisons from last year are negative. So that is the update for the real estate market. Now here's SRS Rocket Report. I wanted to share something here that is of great importance. It says peak gold never. Peak gold is only for those supposed Malthusians who don't realize the law of diminishing marginal utility. However, South Africa proves peak gold is true. Note, was wiser to say stay awake in physics class than economics. Don't share this with Tom Luongo. So here's peak gold in South Africa from 1950 till today, and you can see the ore grades as they decline. We're also, I'm willing to bet, expending much more energy to get these lower ore grades out of the earth. So gold production peaked and then it fell. Same with the ore grades. Ore grades are falling of all different metals, copper, gold, silver, doesn't really matter. Everything is falling in ore grades. And the difficulties to get it out of the ground is becoming greater and greater, which requires more and more energy. So here is South African gold peak. You can see 2020, 2008, we are heading on lower. 2020 is right here. And that did, in fact, peak for South Africa gold production. Now, here's something I also want to share. It's not posted on Twitter, but I'll maybe post it here shortly. So here's gold production looking backwards. So let's go backwards here. This is world gold production. And what you see here is you see these humps and waves, right? 1940, we had a decline in the gold production all the way down here. And then we ramped back up. We had another gold production peak in 1970, and we came all the way back down to about 1980. That was the mania phase in 1979, 1980. We increased production coming on up, and then we've got another decline from about 2000 all the way down to 2010, 2011, where gold eventually peaked. We've come on up in the 2010s, and this is what it looks like for gold supply forecast from Barrick. So we've been coming on up, and we've hit a peak here in 2020, 2021, and we're starting to go down 22, 23, 24, 25, and we're going to decline in gold production. That is the supply of gold. At least these are estimates or forecasts, and they're forecasting that the industry will be in decline. It says industry facing production precipice, very few companies able to deliver value growth in this environment. The same conditions as every single time that I just showed you in history where gold prices went up is in play today. So what makes you think that gold prices are going to go down? We've had a decline here from 70 to 80. We had a decline here from 2000 to 2010, 2011. And then we also have a decline occurring right now ahead of us. So that is in alignment. I remember, I spoke yesterday in my clip yesterday about finding alignments. This is more data on the alignment of the production of gold declining ahead of us. So I just want to let you guys know that. He is thinking maybe perhaps peak gold, and that will never bring this back because the ore grades are going to be so low, and a big and. So a big and that we could also be hitting difficulties in energy extraction, which we could consider to be peak oil. And peak oil would also be peak metals of everything, because your available energy to do work is going to decline rapidly. Perhaps we can find energy from somewhere else, but basically what Earth does, Earth gathers sunlight, and Earth gathers these energy pools, we'll call it, naturally. So the Earth is naturally pooling up oil, uranium, and all these things and putting it in deposits around the world. It's the most efficient way to gather energy because we don't do anything as humans. We just let Earth do its thing, gather it in certain pools or groups of areas, and then we extract those pools of energy. It's the least effort, biggest bang for your buck way to do it. Gathering sunlight is like the first stage of how oil becomes about and how uranium comes about, which is basically a bunch of dead things that gathers and I don't know the whole process, but gathers throughout time in these pools. So I just thought that was interesting. If silver can take out the key resistance line soon enough, $50 in 2023 would not surprise me. Obviously, this is silver, the price of silver in the US dollar. We've got this long-term trend line that's coming, and we're right there trying to break out. It is of no surprise that silver may move sideways a little bit because we're hitting this resistance level. Once the sellers become overwhelmed, the buyers are going to rip this to the upside, and we'll see an upside move. How long that will take, I don't know. No one knows exactly how long it will take, but we are hitting resistance levels. We're trying to break through. That is the first stage of what it takes to break through these levels. Coming on down, it says, according to the data, conventional oil production, the high quality, high energy return on investment stuff and more profitable, peaked in 2005, 2006, and has been trending lower. However, when global debt bubble bursts, so will assets and capex to produce oil. Energy cliff, much worse than peak oil. So you've got this relationship. You've got oil that feeds GDP, that sustains the global debt that we've got in the world. So as long as global debt and GDP go up together and they are somewhat balanced, you don't get this gigantic difference between debt and GDP, which is inflation. The problem is when you have a constraint or if something happens in your oil production, which is the number one commodity, then you've got a problem with your GDP. And if you've got a problem with your GDP, you're going to have a problem with your global debt. You need GDP to go up in roughly the same amount as your global debt. That's what keeps this whole system in balance. Keeps it in balance. What is happening here is we could be hitting global conventional oil, condensate, heavy oil, and tight oil production peaks here very soon. That's going to strain your GDP or constrain your GDP, which then is going to put a bunch of stress on your global debt. That is where I continually go back and forth to figure out what would be the best investment in that type of scenario. And I think when you look at it and you really think about it, I think it really points to physical metals as a store of wealth. You can invest in oil, but the problem is debt finances oil, which is the capex to produce oil. So you've got this relationship or this loop where debt finances oil and oil finances GDP. And it's this gigantic circular loop that keeps going back and forth. And then when you get more GDP, you get more financing and more financing and more oil production. Oil production, I don't think can go forever. There's going to be a limit to how much you can flow out of the earth, especially conventional oil. And that will strain the global debt and it will burst. So I don't know. I've been leaning more towards physical metals as of the last year, even though I still own a good chunk in a lot of these commodities. All of the commodities in the world are just derivatives of oil. Oil is what basically lubricates, puts gasoline, diesel, all of these things in motion to get out of the ground. The chemicals that it takes to get it out of the ground, et cetera, et cetera. So one could conclude that everything in this world is more or less a derivative of energy, and or a lot of the stuff in the world is a derivative of oil. So if oil has problems, then all of the derivatives of oil, which is commodities and everything in this world, could also have problems if you're constrained by energy. Coming on down, it says, what happens if US, Europe enter recession? Demand falls 0.6 million barrels per day. China normalizes. Non-OECD Chinese demand grows by 1 million barrels a day. And OPEC voluntary cut compliance is high. This is what happens. The lowest inventory level in likely 10 plus years. We remain bullish. So from a fundamental perspective, what he's basically saying is that if we have a recession, it's not going to kill enough oil demand to replenish our inventory levels. We are still going to suck down our oil inventories, and prices should remain robust. Now, there is a relationship here with the physical demand and physical supply of oil and the global debt in the system. Debt, so historically what would happen is debt would rise faster than your supply, creating an imbalance in the system. And then eventually oil supply would catch up. If you hit an oil supply problem where oil supply cannot grow, you cannot increase your global debt. The problem is you have to increase your global debt in order to service the existing debt in the system. It must continually grow. And you get an imbalance between global debt, GDP, and oil and all these other things that are of real things in the economy. Coming on down, it says buying Silver Eagles at 80% plus premiums to spot is like willingly choosing to pay airport prices for a bottle of water. As in, you're not even flying today, just felt like wasting your money. Now, here is something that I will say. If this is a big if this is screwed up here for oil, this here is going to be a resultant of that positioning by everyone in the world. You could see premiums go up, and if they're trying to manipulate the futures pricing of any of these metals or commodities, you're going to start seeing the premiums start to shoot higher. Now, is this premium temporary? I don't know. If we are entering a problem with global debt, you're going to see this premium skyrocket, just like we are right now. How high is it going to get? I don't know. And how sustaining is it? I don't know. No one knows. But this is the thing that you would see if there is a problem in the system. We're seeing it right now. Stephen Van Meter says, sell gold now. David Hunter says, buy gold now. Who do you believe? Answer, both smart men. All markets are made of buyers and sellers. Your job is to find out logic behind seller and buyer. Opposing logic makes you smarter, which is more valuable than the money that you can make. I am in the camp that if gold is going to go higher no matter what, if you give it a long-term time frame. If you have a short time frame and you try doing stuff in the short term, then yeah, he might be right if gold goes down a little bit. But I just don't think that's the case. You can't have a long-term deflation. We've had deflation for a short period of time for a very small duration. 2008, 2009. That's it. Everywhere else has been inflation. So if I were to take a guess, I would agree with David Hunter. I don't know his logic behind it, but I agree that buy gold now is what I would do, and I believe that's the right viewpoint to have. Sell gold now is wrong because everything that we look at technically conflicts with Steve Van Meter. It doesn't matter if I lose money in a short-term time frame if he's right anyway. Because if I hold on, you're going to be right on the midterm and long term if we're wrong in the short term. If we are. If I'm wrong in the short term and gold goes down to $1,600 or $1,700, who cares? What are they going to do? Have like permanent deflation? If permanent deflation happens, gold's going to rocket because all of the debt in the system goes bust. will go bust. And they're not going to do that. That's my opinion. Here's copper. So tightest supply in 18 years boosts copper ahead of industry show. Executives, bankers, traders gather in Santiago for Cresco Week or Cesco Week. China reopening and supply stumbles explain metals resilience. We've talked about copper every day in the daily market update, how resilient it is. It's sitting on top of support. Well, this is the reason why. LME inventories are approaching the lowest level in 18 years. And I've talked about copper moving higher to $8 or $7 or $10 or whatever it's going to go to. It's because of these tight inventories. Here's Jenny. She says, Toyota CEO, this new engine will destroy the entire EV industry. Hydrogen-powered internal combustion engine looking like the future of automotive technology. Looks like I might have been right with respect to Toyota, wrong on fuel cells. So we could see hydrogen-powered internal combustion engines. The reason they would dominate is because of the mineral intensity that it would consume to make the cars. And EVs would go to the wayside. Coming on down, it says from Grady, that possible blue inverse head and shoulders pattern is quite unbalanced with different size shoulders, but still valid. And that purple expanding falling wedge is usually a very bullish pattern. So it could give it energy to break out of above the blue line. So this is GDX. We've got an inverted shoulder, head, shoulder. We can see this pattern in a lot of the individual companies as well. I'm getting uber bullish. I've got yellow fever, gold fever, yellow fever. I think I see all these chart setups and patterns in the precious metals, gold and silver mining companies. This is also signaling the market conditions that are coming. We could see a scare in the short term that boosts these things to the moon. So what does that look like? It looks like this. We get a scare in the markets, we get a recession or a threat of a recession, and some things go bust. What do they always do to bail things out? They print money. That is what's going to send this to Jupiter, to the moon, to Jupiter, to Saturn, to Mars, to Uranus. It's going to Uranus. All right, we're going way up there when they print that money. And when they print that money, it's going to take a little bit of time. Gold's going to immediately account for that money. Gold, silver, rocket ships, boom. And then about 6 months behind it, 6 to 7 months or something like that, oil is going to take off. All these other ones are going to take off. Uranium is going to go to Uranus. All right, they're all going to take off. So what we're doing is we're waiting for that money printing reflation type of event. It could take a little bit. They might want to try to squeeze this market. It seems like that's what they want to do. They're going to squeeze the market. They're going to try to bring this stuff down. It may give you one last buying opportunity in a lot of these different things, the metals, maybe oil, maybe natural gas, maybe some of the companies will come back a little bit. And then when we hit that bottom and they print that money, they're going to send it to the moon. So the patterns are all there. Shoulder, head, shoulder. The setup is there. Could this come back a little bit? Yeah, maybe, maybe not. I'm not betting on it. I'm betting on it going up. But that's my take there, and that's the setup. Grady again, it says the probable blue wedge backtest held. Orange rounded bottom arc is working so far, and that looks like a pink backtest right now. Could get a double bottom down at 1301 level, though, as arcs are fragile patterns when they start out. This is palladium. Palladium's been basically moving down in a wedge pattern. We're starting to get some firming up in palladium. And I think palladium looks like it's ready to break out. I think it was up a lot today. Platinum is also, this is also going to help platinum. Platinum and palladium are going to move on higher, and it's probably going to be a big old move in everything. In everything type melt up move at some point. Now, this is more information, guys. So all of these charts are interconnected. They all are saying the same thing. This is saying the same thing. And this is where I get a little bit scared. All right. It says if something like this plays out, it would probably destroy the U.S. bond market, plus maybe send us into a depression. Fed would probably save the bond market before the USD, but the global leveraged debt mountain could take down bonds anyway. And I totally agree with him. I go over this the daily. in our daily analysis. I've talked about these a bunch. This is a shoulder, head, shoulder, and I've scribed this out before with a neckline down here. So if this comes up and then we come down, this here is that one last buying opportunity that I talk about, that I've been talking about in potentially oil and whatnot. And let me just pull up something, all right? Let me pull up and show you what I mean and tie this all together, all right? So this here is your TLT monthly. This is bond prices. When this goes up and we break down, and it can go down here. The shoulder doesn't have to go all the way up here. We can come lower. Again, I don't know, and he doesn't know either, where that's going to end up. When this goes like this down, what we're going to see is that same pattern inversely correlated on oil. So if we look at oil and we inversely correlate this, you're going to get a inverted shoulder, head, shoulder break. And that's when the big move comes. And again, this may not go all the way down. It doesn't have to, but it could. So this is XOP, is the version flipped over. This is flipped over. This is inverted, and this is regular. So this coming back down is going to be fuel for this to just go ballistic. So everything is set up for that to happen. The reason this is going to go down and this is going to go up is the money rotation out of TLT and stocks into this. This here is the head. This is the first head that we've got. We're putting in a shoulder, and then we're going to move higher. Markets don't move straight up, and they're going to get you all twisted and bent up in your positions. What I am saying is, don't get bent up. Don't get twisted. Use this information that I'm showing you to gain the confidence to say, you know what, I'm going to ride this out, and I'm going to cost average in and get this whole bottom here. Because finding value is doing that, or whoever else. So this is just one inverse thing. The reason this is all going to go is because the U.S. Treasury yields, these are yields, are going to get one last back test. This will be the flushing of everything out of the system, the flushing and people running to debt. So the yields will come back down a little bit, and then we're gonna move to the upside. So we could have one last flush out sometime soon, where yields basically wipe all this bad debt out of the system, or some of the bad debt. Some of that bad debt could be commercial real estate. Some of the bad debt could be in businesses, wherever it is. We could see a scare, and then we rocket launch from the reflation trade, from the money that will be printed to save the system. To save the system. And all that money is going to rotate into our boys over here that we're watching, commodities. One thing that I see platinum's trending higher price-wise, but so are the premiums as well. I'm starting to see some premiums go up. Inventory falls even lower, correct. And then I'm going into some of the other stuff here with GDX and gold miners, and they look good against other ETFs. Everything looks pretty crazy good for GDX and gold. So another thing, just to kind of close this thing up, GDX and gold do very well when these things start to uninvert, the yield curve. When it uninverts, we're going to see all this go positive, just like we're seeing. So I do think that we're at the beginning of that pullback. We could get a shoulder in oil. We can get a move lower even in uranium in the short term. It's going to scare everyone. Not this guy. I'm going to be buying the crap out of it. So don't be scared. I'm going to ride through it. I already own a bunch, and I'm going to continue to add into it, because what I think in the bigger picture view, we're going to be going higher to the upside. And this is going to be the big move. The big move occurs after this last flush out. The flush out occurred last bull market in 2000 to 2002, and then we come out and we rip it after that. So I think we could see a big move in gold and silver. Gold and silver is going to continue to go up. I think we're going to see a pullback in yields for a period of time. And this here is what's going to be considered a bull trap, or a bear trap, sorry, a bear trap. So the bears are going to think this thing's going to go all the way down. A lot of people are going to get short. They're going to short commodities. They're going to short oil. They're going to short all these things, and then it's going to reverse and go way, way higher on them. How big is the pullback going to be? I don't know. I don't know how big the pullback can be. It could be super shallow and it just rips it, or it could be deeper as we flush things out of the system. Maybe we already flushed everything out of the system. So again, I'm not trying to predict it. I'm staying long. If we get the pullback, I'm going to be buying more. That's the way I'm playing it. But that's what I see as a setup in the markets, and everything's, I don't know, everything's looking good for gold and silver, and we could have one last pullback in some of these other ones. It's possible. But if you guys like the content, give me a thumbs up, subscribe to the channel if you haven't, and we'll catch you later. This is Finding Value.